So let's get this party started, almost getting there. So hope everybody's having a great day wherever you are, whatever you may be doing, and let's go. So no trade calls, no recommendations. Everybody sponsor their own stuff. We're here for educational purpose only. And this will be recorded, so it'll be up on YouTube later on. So hope everybody's having a great day, and let's go. I've got some time to spare. As I said, we'll do this once a month and go through as many charts as we can. As long as people have questions or we have something to discuss, I'm more than happy to stay on. And let's see what happens. So FLR chart. Is that Floor Corporation you're talking about? And do you have, just give me a specific, what you're looking at, daily, weekly? Is there anything specific you're focused on? All right, so I have no idea what this is, so we can have a look at it, but looks like it's gotten schwabammed, and market's trying to keep pressure on here. It's still trading below the 10-month moving average, but it looks like there's some bids trying to support it here, right? You can see on the weekly, you're getting buyers coming in, unable to take out those lows, and it looks like right now we're stuck in a very, very tight kind of range here. And the way you would look at this on the weekly is that if you get closes below, then high odds this thing is going to come back down into this lower area of support. Whereas if it can take out the upside with some gusto, especially the 50 week, then high odds that it comes all the way back into these highs. I mean, I don't know what this chart is, what the company does, but it looks fairly choppy. If you look at it on a daily, to me, it's really not very interesting to me, right? Because you see, even if you're looking at this recent range that the market seems to be holding in, we're pretty much stuck in the middle of this range. So to me, you have not an awful edge in trading in the middle of the range. So this is not something I would be too focused on, right? I mean, if you're into nuclear, I mean, it makes sense. I'd rather just be long uranium. That's a long-term trade we've had on for years. But that's what I'd say about this chart here. Yeah, here it looks like, as we're saying with Mr. Deadlift, here it looks like the market is kind of stuck and it's trying to coil, but you're just getting a lot of wheeling and dealing, right? Now, we've talked about this, and I talked about this a lot on Twitter, basically how the levels to watch essentially are just how the market is coiling around the 4,300 on ES, 34,000 on the NASDAQ, on YM, 15K on the NASDAQ, right? And those are the real bull-bear lines you want to focus on. Now, the fact that we're wheeling and dealing around that, it makes things very, very choppy, but those are the levels that are really being defended, right? So as long as we don't get any clear traction outside of that area, there's just an awful lot of chop going on. I think the nicest plays have been in trying to play for this long side on the equities, especially on the NASDAQ. And, we talked about in the webinars how we've seen basically this rotation out of tech and, into YM and Russell, and the trades being, to try and play that rotation and not get in the way, if anything, be short NASDAQ, right? Then we covered all the shorts, and right now, especially on the Facebook news the other day, what we said coming into the trade, I tried to highlight that on Twitter too. We said, you had this, it got smacked into the panic, right? When we come through the previous day, and you can go back on a 4-hour chart, you can see this is a very, very important support zone. Once we come back through this yesterday and we hold, the only trade is long. And as I discussed with Daniel on Twitter, it's to play for a move back into the scene of the crime. Don't make it harder than it should be. don't look at different support or resistances. Just think of it as scene of the crime, where the panic came on the Facebook being down, WhatsApp being down, etc. If you don't get follow through in terms of the negative news, it's almost like one of those rogue headlines that hits the wires. That as soon as the fear comes out and there's no follow through, then the path of least resistance is back into the scene of the crime. And that was a beautiful trade yesterday, right? Now, what's happened today? We got another smackdown. But again, if the market can't press below this support zone, the asymmetry is going to be in as soon as we pop our heads back above this level to get long, right, for a probe higher. This is kind of like that ball, and they're pushing it underwater, pushing it underwater, pushing it underwater. As long as you can hold it underwater, it's fine. But the moment you let go, bang, it can really pop to the upside, and that's the risk. I mean, in the same sense that you don't want to be aggressively long if we start trading back below this area, or if we break the lows. If anything, you want to go with a flow, because there could be a very big flush to the downside, so you'd want to be short. You don't want to fight the long. But as long as we're holding back above this area, the trade is to continue to look for tactical longs for this ball to try and pop out of water and come back into the 15,000 mark, right? But the market's been fairly technical today, and there've been a lot of nice opportunities, in terms of things reaching extremes. You see how we've got Kiwi right back into a DS3, bounced, euro holding at a DS3. So, the market's been fairly technical, and we're holding around a bunch of key numbers we've been looking at for a long time, right? Whether that's on Euro GBP, whether that's on Swissy, whether that's on yen, whether that's on gold, whether that's on crude. This is a multi-year high, I think 2014, last time we traded above this. So the market is fairly technical. You're just seeing a lot of choppy action. And again, is it surprising that you're seeing that choppy action as we wait for non-farm payrolls? Absolutely not. And again, it's going to be interesting because also we're going into OPEX week, so it should be interesting, right? Well, here you've got it's a similar scenario across the board, right? In the sense that the market is trading quite heavy. So, and you can, if you're looking at DAX, right? You could see how we're very, very heavy through the 200 and into this big support zone, Arno, right? Let me know if this makes sense. So here, this is clearly, it's the same situation as on the US indices. It's for the bears to lose, right? Because the bears are in control. The best way to look at it is, they've got the ball under the water and they're pressing it down, right? Not to use other analogies that are probably going to get me banned from YouTube, right? But it's up to them to lose it, because when you get this kind of action, if they can't hold it and you start seeing closes back above, you could get very quick snapback. Does that make sense? Now, it doesn't have to be a snapback for all-time highs. It doesn't have to be a snapback for the end of the year Q4 rally all the way into the close, but it could still be just a corrective snapback in the context of a broader move down, right? So that's the I'll get to it. I'm just taking the long road. So you have to be careful here. But what's important is that you don't want to fight the flow if we break these supports, because that's when you have the risk of these things really flushing. Okay. So here. Hold on. It's exactly this very similar situation that you've got on the Nikkei, right? It's basically gone nowhere. And you remember from the webinars, we said just really don't understand how you'd want to press longs at these all-time nosebleed levels on the Nikkei, right? So the question is here, what to do? So you want to know, would you be looking? You're looking for longs and you're wondering if it's better to get long Nikkei or US indices? So while you answer that, and we're a very, very similar zone here, right? It's kind of stuck. and you do not want to be long if we lose this stronger support. Now, I'm gonna personally, I don't want anything to do with Nikkei at all in terms of longs. Okay, so that's not a trade I would take. But if you look at them even side by side, right, and let's do this, and you've got the Nikkei here, and what do you want to do? You choose ES, YM, or NASDAQ. So I probably, okay, YM, I would have chosen another one, but that's good. You see how the action on the, just technically the YM is stronger, right? Because the US indices are very different. But here, you've got a very, very harsh move down on the Nikkei. It's gone absolutely nowhere. And on the way up, you're going to have a bunch of different kinds of resistances, whether you're looking at trend lines, whether you're looking at all these moving averages, and it's just really gone knife through butter. It's been a very ugly break, right? Whereas the difference is on the YM, if you remember, we've talked about how it's been dancing around this basically 35,000, 34,000 zone looking for direction. But you see that on the moves down, it's being supported. The 200 was protected, the 200 was protected, and now we're back inside this area, right? So to me, the YM is far stronger, is better location and better area, right? Also, I would prefer I'd prefer YM if I gun to my head between the two. Okay, and again, the situation is also very, very different, and on U.S. indices in terms of location, because we'll have to see based on what happens with rates, what happens in with the Fed, etc. You could see different kind of rotations between tech and YM, but keep in mind that inflation keeps on picking up. Money needs to find a home, and to try and offset inflation, or deal with inflation, people are going to be chasing stocks, right? Because basically, a lot of people talk about other inflation hedges, but stocks are, that it's a classic inflation hedge. So you should see all equities do well, but most likely, you'll tend to see the usual, infrastructure, consumer discretionary, banks, regional banks, all those do much better. So you'd prefer to be, if you were looking for that trade too, you'd prefer to be long, something like YM and Russell. Also, don't forget that the seasonals are very, very strong coming up also for the year-end rally, and especially for something like the Russell relative to tech and stuff. So I would prefer one of those. But if you're just looking at the charts, and again, everything can change. Everything could change on a dime, but the charts clearly the YM is stronger, right? The YM is stronger is had a lot less had to deal with a lot less damage than Nikkei. Okay. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? While we wait for, if anybody has other questions, and I urge you to ask away, because if we don't have any questions, I'll just look at a couple of things and then I'll just shut it down. But something I would urge you to keep an eye out for is the bond complex, right? And I know this is basically very, very controversial because everybody has different take on bonds, and a lot of people have different bias, and et cetera, et cetera. So and there are a lot of different narratives shooting around on the bonds. But basically, something which I'd want to just highlight, which I think is interesting and important here, right? So you've got a situation. Hold on, my phone's ringing. I'm gonna have to kill somebody for calling during the webinar. And so basically here, if you look at the bonds, basically everybody's getting really obsessed, right, about what's happening here with yields, trying to predict what the next move is going to be in yields. And the only thing I would like to say is, as long, keep in mind that that basically, as long as we don't really take out these highs, or we don't really print aggressively below these lows, we're seeing an awful lot of chop here, right? And you don't have to, you can get a lot of nice trading conditions and a lot of moves, even if we, broadly speaking, just stay stuck inside this range, right? So don't feel like you have to make a call for us going to 2.53, or you have to make a call for us going back to 0. There's plenty of trading to be done here. And the worst thing you want to do when we're stuck around this 1.5 range is to have an extremely strong opinion that fixes you on a specific path and makes you and forces you to see the charts or the market in a specific way. Keep an open mind and be ready to trade both sides, right? Now here, and again, markets should not only move in a straight line, so don't be surprised if you see healthy moves. But something which I would definitely keep an eye out for here is look at the Bund, right? Because if you see what's happening here on the Bund, right, we've had a very, very aggressive move, massacred a lot of people, but here it's starting to base, and you want to watch this very, very closely, right? Because on this break, you've got a lot of people that are likely stuck with very poor location on the short end side. And here, if we start to get back above this zone, you could easily see a quick squeeze all the way back into the top end of this range. And this is something that you want to watch closely, because I've also seen a lot of people saying, you got to keep on pressing the short side on the 10-year and everything because Bund's broken down. But, keep an eye here, because it really hasn't, it needs to get traction, right? And what you can see, on the other hand, if you're looking on the 10-year, is you see that the 10-year basically, right, we've made a series of higher lows, right? If you look at ZF, similar thing. So, don't be surprised if you see some profit taking on this recent move. And the big test here is, on this first retracement, they had to smash it down to get aggressive follow through. And the fact that they're not managing to get aggressive follow through here, if you're aggressively short here, in the shorter term should be cause for concern, because you could easily see this coming back to the middle of this range, and of course that's going to have an effect on dollar, on everything else, right? So just be a little bit careful there, okay? Euro. So Euro's finally making a stab to this 115. This is something we had called and we talked about for a long time. And this is the next interesting pivotal level, and likely the non-farm payrolls is going to be, the key event to give us a little bit more direction of what's going to happen on the euro, right? As long as we're stuck inside this range, I think it's a range trade. It gets extremely heavy below this 115. Daily closes below 115, and above 117, you've got a real possibility of an aggressive squeeze all the way back into the 20. But as long as we're stuck here, so far it's heavy, right? Especially as long as it's holding below the 10-day, it's still holding a little bit heavy, right? And you can see, similar thing on cable, which already finished those extension targets into the 123. But, it looks like you're seeing everything else starting to trying to base. So again, I wouldn't be surprised if you see again Aussie slowly turn and try and make its way back into the 0.75. Kiwi try and stall here, this series of lower highs, and make its way back into the 70. So that's the risk. I mean, trying to make a big call ahead of next week non-farm payrolls, even though it could be a little bit of a dud. We'll have to see. You know, the biggest question on non-farm payrolls, it seems to be fairly clear and a done deal, is if you get a shockingly bad number. That's probably the big question mark. And it's not unlikely that we get a disappointing number, but the really bad, ugly number, that could be a bit of a head scratcher. Over a lot of people are going to have to digest that, because usually you would expect, you know, bad is good, but maybe not in this case. So as always, I would still just let price guide and see what happens. But at least here in the short term, I would not be surprised, especially if we can stabilize a little bit more today, to see equities catch a little bit of a bid. And because we've seen this strong move rotation into YM and out of tech, and you can see that in 2 days ago, NASDAQ was breaking new day lows, and ES and YM weren't taking out the previous day lows. If we get a little bit of a pause and a little bit of a snapback in equities, you would expect to see the opposite. So to see NASDAQ outperform the others, right? Just a little bit of a snapback. So that's what I would be looking for. And again, that ties into also the dollar here, right? And 94.50 is the line in the sand, right? Are we going to hold or not? And this is very important because of this dip that got bought, and if we can't get day closes above here, then there's a very, very good chance that the move back into 93 could be very, very quick. If we hold above the 94.50 day closes, then this could really start to rip. Keep in mind that we haven't had day closes above that level for ages, right? We pierced our heads above it in October of 2020, but really we didn't have day closes until since summer of 2020. So that's a similar kind of location or similar kind of discussion to what's going on crude, right? Once you get an area that hasn't been, just like it was 2014, right? Where you haven't had day closes for ages, once we pop above, it hits a lot of stops, a lot of buy stops, and you get a lot of upside pressure. So it's the same thing on the DXY. If we start to trade above there, the last thing you want to do is try to fight it to the short side, because you could easily get taken out very, very quickly. As long as it fails, then this is interesting, because you could have very tight asymmetry to try and get tactically short if you wanted to. But, remember, a lot of people forget new highs or multi-week highs, multi-month highs, multi-year highs are bullish. They're not bearish, right? So be careful there. I don't want to monopolize the chat, but with the swing in mind, U.S. indices do poorly versus Nikkei in midterm years. Hence my question. Yeah, but those stats, it's kind of like, all those free stats, they're free for a reason. You see what I mean? And all those websites that are giving you all the average performance, all things on pre-election year, post-election year, Democrat year, Republican midterm, yada yada. It's, if there was real edge trading that, the guy who's publishing the website would not be publishing the website. They would be sitting in a tropical island somewhere. You see what I mean? So they're good for guidelines, but you always have to look at it in the context of what's going on at the specific time. And remember, it's just an average, right? And every year is different. So to me, those are like almost, even less interesting than basic seasonality. But Do you see what I mean? I mean, again, in the let's see what happened this year. Prime Minister resigned, new Prime Minister, etc. How many of those midterm years that are in the average had a year where the Prime Minister resigned and was coming in with completely different, you see what I mean? There's so many factors. So I would never, I always look at those things as interesting, but at best they confirm your analysis. At worst, they give you a bias, but they really don't factor in at all in my trading personally. Okay. Yeah, here usually October tends to be, since we're talking about seasonal, October tends to be whippy, a lot of choppy. The seasonal kind of bull run kicks in later on. So we're still in that first half, which is very, very choppy. Then we're going to go into OPEX week and we'll see. But, it's really how we trade through non-farm payrolls and what else we get on deck. But as always, just use those levels to guide, 4,300 on the ES, 34,000 on the on Y, broader picture in terms of swings. As long as you're below those, you don't want to stay long, right? And as long as you're above, you don't necessarily want to stay short, right? Especially if you're close to them, because you can use that location to construct very nice asymmetric opportunities on both sides. Germany, what are the levels to watch on Germany? Well, here, again, I don't really watch this that carefully, but you see how you've got this kind of level. Actually, let me do it this way. You have this pop up. Then you have that failure, and we reversed a little bit. And once we broke through, the market keeps on holding. Does it make sense? So to me, this is the only level that matters. And this is really holding the strong breakout. Tried to rip, bam, and it's trying to, if this can't hold, then as I said, it gets very, very ugly. It's similar to like some of those indices. It's like if YM breaks those lows, if ES breaks those lows, then it probably opens up another 5 to 10% easy to the downside. But especially on the DAX, there's a lot of damage that can be done here if we break below. So today's low is absolutely of capital importance. Any closes below there and it could get ugly. That's the bull bear line I would use, today's low. Yeah, every time I do these, because the market's moving, I thought, okay, we're going to get some action. We're going to be able to do some trading live and stuff. And then I seem to jinx it. They slow down a little bit, right? Yeah, here what you're seeing is going to be interesting, but you see how Swissy's back stuck at this level. You actually had a 4-hour close back inside previous day range. So here, if the risk is like everything, is that we give back. If they can't, we give back this recent ramp. But I really don't think that Swissy's that interesting here. I think the focus is really on equities. I think that the levels to watch, those magnet areas, are still the 111 on yen, the 93 on Swissy, 85 on Euro GBP. Here you've got the 115 on Euro, but 1750 on gold. But really, it's all about what's happening on the equity side. That's the most interesting area, right? But especially with the kind of effort that's being put here to smash these down, there could really be a nice coil to the upside if they can't get any traction, right? So even look at it in terms of Fangman, right? We discussed this the other day. There's a lot of interesting trades that you could structure around this zone, but you can't get, nothing goes down in a straight line. Well, healthy moves don't go up a sustained line, either to the upside or the downside. But once you see this big correction, and keep in mind here, off those highs, we've come down. You've had pretty much a 10% correction off those highs, right? And when we go straight into this level, this is a key level we've had on our chart for an awfully long time, right? And the market stops on the dime, right? You can't short this, right? And you get into a situation here where both the longs are thinking, okay, let me take some off, and if I really want to short it, I'll short it higher. And also the longs see as the key point, and you start saying, okay, let me give it a shot tactically. So what tends to happen here, you've predominantly got longs coming here. The only new shorts here have very poor location. So you would expect this to, at the very least, try and pop back up into, the 50 back of the move from A to B, back into these moving averages, and then it'll be game on to see if it can get more traction. So it's very dangerous location to press. So it's almost like if you want to press short, you'd much rather press it on the break lower for a flush into the 200. But here, and if you're looking at the similar thing on the ES, anything can happen, okay? But look at this here. This is basically, we came into this level, market's trying to hold it. We rally back. The bulls think they've got it, and the bears say, no way, we smash it down hard. By the way, it's still holding these beautiful zones we had set up, right? And then look at it, back into this level is day one, thou shalt not pass. Day two, probes lower, they close it back at the level. Day three, probes lower, they keep on coming in. Look at the wicks. Day four, today, it doesn't mean it can't crumble. And that's why if it crumbles, when there's so much volume and so much effort being put on to support it here, if it loses, you'd expect it to hit a complete air pocket and just flush 100 points down in a heartbeat. However, as long as the support doesn't break, it doesn't break. And they're very, everybody, either shorts who haven't covered or new shorts here, have very poor locations. So the moment those guys have to cover with all people that are seeing this tactically trying to trade the long side, you could see 4,400 in a heartbeat too. So you just have to be careful here trying to press the short side. Russell, YM, similar thing, but especially on the ES, it's tricky, right? You can't press the short side. I mean, I've been flat on my shorts for a couple of days already, since last week actually, and it was a very nice move off those negative closes at highs. It was pretty much nice 5% move. 2 times came down, bounced, got a chance to get back short, but here it just doesn't look like it wants to get traction. Doesn't mean it can't get traction, absolutely not, right? But it's not what price is telling you here. Does that make sense? Okay. Any comments, any questions, anything anybody's been looking at, anything anybody wants to discuss? Okay, guys. Thank you for stopping by, spending some time with me. Hope this was useful. Wishing everybody an awesome rest of the day, an awesome week ahead. Stay safe. Don't get too big. Don't get no hero trades on non-farm payrolls. And have a massively awesome weekend. Okay, we'll do this again in a month or so. Take care. All the best. Bye-bye, guys. Thank you so much.